I'd like to welcome former chair of the President's Council of Economic Advisors under George W. Bush, Ed Lazear. Ed, thanks for joining me. I'm going to jump right into it. 263,000 jobs, more than many had predicted. And if you look at non-seasonally adjusted establishment household, no matter what you look at, it even gets stronger than what we saw. November 69 last time, and an unemployment rate was this low. It was 3.6. 60.6 employment to population. I know that's one of your favorites, Ed. It was steady. We lost a couple of tenths on participation. The one thing I noticed, even though year-over-year wages were 3.2, I'd like to see a bit higher. This is the 9th month it's been 3% or higher. It started in July of 2018. All right, take it away, Ed.
Okay, just a couple of additional comments. Absolutely, Rick. The one thing I would say is that the job growth is still very high, and I don't mean just this month. So I always look at the 3-month average. It's 169,000. That's still well above what we need to keep up with population. I heard the discussion this morning about that. There really is no other interpretation. If you're growing at a rate higher than the population growth rate, it tells you we're still recovering jobs, and that's good. We said that years ago, that there were still jobs to be gained, and those jobs are still being gained. So that's good news. The other thing, just your point on wages, the 3.2% is actually quite good. And the fact that, as you point out, it's been there for a while is significant. It really does affect the average American worker. Why? Well, if you look at it and you take out inflation and you say, what does that mean net of inflation? It's still about 1.5%. And that's about 3 times as high as the average rate of wage growth in real terms that we've seen over the past 2 decades. So again, a big deal. The one negative thing that I would point out that hadn't been mentioned is the average weekly hours was down a tenth of an hour. That's significant. As you know, that's a lot of jobs in terms of the amount of demand in the labor force. So that's something that we want to watch. It's bounced around a little bit in the past few months, but I hope that would come back up to 34.5 next month. So that's about it.
Let's shift it in. Yeah. Let's shift it in third gear and cover a lot in the next minute and a half or so. Okay, another issue. Everybody seems to be debating, oh, we can't possibly go 3% or higher like Hassett and the president and the vice president have said. All right, let's look at it another way. Many think we're going to go back to 2%. I personally don't think so. So let's go somewhere in the middle, 2.5%. We have a $20 trillion economy, an extra 0.5%. That's sizable. That's $100 billion a year. Can you make a comment?
Yeah, absolutely. Yeah, those are, these numbers seem small. When you're thinking about tenths of a percentage point, they seem small. But when you put them in absolute dollars, it matters a lot. And in terms of the future, the good news, as everybody's pointed out this morning, is that the productivity number was really very good this last quarter. And it's actually been good for the last year. There are 2 ways that productivity growth can take off. One is you get workers to work harder. That happens during recessions and the early parts of recovery. The other is technological change and capital deepening, and that looks like what we're having. Look at investment. Look at the last GDP report. We're seeing investment rates that are up 5 to 6% per year. That's way different from what we had in the past. So that's really good news, and it is, I would say, it suggests a bright future in terms of positive GDP growth over the next year or so.